I'm more of a short-term trader, but you can use cash secured puts for long-term. There are a couple of different ways to use this. If you are doing longer-term trading, then the fundamentals of the stock actually matter, right? Not a company, not the whole bankruptcy thing. Obviously, bankruptcy is a fundamental feature that you want to know about, but I'm talking about more of the common stuff, how liquid a stock is, how much cash they have, well, what are their earnings look like, what do their dividends look like, valuation, right? Margins, that sort of thing, what their outlook is. That stuff's going to matter if you plan on being in a trade for a long time, right? Because there's a point where either you might take ownership or at the very least, you want it to stay above a certain amount or go up. So if you're going to hold it, and I'll show you an example of this for like 3, 6 months or a year, or, something like that, then knowing more about the company is important. And now, if you're going to do a shorter term trade, which I think probably most of us are shorter term traders with options, right? You might buy stocks. I know most of us buy stocks in our 401k or IRA or whatever, but in terms of options, right? Most people are doing options from a shorter term perspective. And so you don't need to care as much about the stock. You still need to know what's going on, and you need to know what events are going on besides just earnings, right? You need to know if there's a company launching a product, or if there's a lawsuit that's about to be settled, or some new product, get a new trial in a biotech or whatever, right? Obviously, you need to know about events that might happen while you're holding. You might want to avoid stuff that's heavily shorted, right? Sometimes that's an opportunity, but if you want to be safe, things that are heavily shorted, those overnight can drop quite a bit, right? In some situations. So just things you need to be aware of. And then I think the most important thing here is option liquidity, right? If you're doing a shorter term trade, then it matters where you're getting your fill price and if you can get in or out of it relatively quickly, right? So that becomes important. If you're a longer term trade, then you can take your time, set limit orders, and give it a few days to get in or out or something, right? If you're going to be in for 3 or 6 months, it's not necessarily a rush for your entry point. If you're doing a short term trade, really anything under a month, and particularly if you're doing it like 2 weeks or under, then yeah, the pennies start to add up and they start to matter. So liquidity becomes important. All right. So talked about slightly longer term trade. Here's an example of one with Tesla, trading $444. So this is about a 3 month trade, January out to January. It's roughly 3 months. This might be so. Let's say every 3 months you wanted to sell a put on Tesla. You can go pretty far out of the money and still get some premium because Tesla is obviously a more volatile stock, right? It moves around quite a bit than, something like, Walmart, for example, right? So 325 strike, that's quite a bit a ways, right? That's, not quite $125 away, which is, what is that? 25%, not more, 30%, 25% out of the money, right? Pretty decent move. You wouldn't expect it to happen. But because Tesla can move a lot, there's still a lot of premium here. You can see almost $6.50 for that, which is 2%, right? So now 2% doesn't sound like a lot, but you don't have a whole lot of risk of Tesla. I mean, there's obviously risk, or you wouldn't be able to sell it for this much, but you don't have a ton of risk of Tesla going under 325 over the course of 3 months, right? Something pretty bad would have to happen for a stock like Tesla to drop that much. So it's 2%, but highly unlikely that you're going to have to do anything with this trade. Most likely it'll expire worthless. You think about if you do it this is roughly 3 month trade. You do it every 3 months for roughly the same amount. You're making about 8% a year. That's about the average of buy and hold stocks, right? 8% a year is like the average, the long-term average of holding stocks. So not bad, right? I mean, you can obviously just hold stocks for that amount, but just as a comparison, not bad for something that's pretty far out of the money. So this is a situation there where you want to know more about Tesla. If you're going to do this every 3 months, you want to know what are the chances that Tesla's going to go under 325 and stay there, right? So you want to know a little bit about, well, what's their upside potential, right? Are people done with electric cars or does Tesla getting into a new area that's super interesting? So that sort of thing, right? You want to at least know a little bit about the company and, more about it because it's a longer term trade.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review Netpicks' full risk